Today's episode is on how to calculate positive cash flow on rental property. When you're considering whether or not to buy a rental property, you're going to have to do a certain amount of calculations to figure out if the ROI on that property is something you want or not something you want. If it's not something you want, you can always make a counter offer at a lower price to up your ROI, but we've got to be able to do the calculations. So let's start with some basic things that you have to know. There's a bunch of obvious expenses that you'll need to know. You know, there's debt service, electric, water, maintenance, insurance, property taxes, management fee, bookkeeping, the list goes on. Most of those are pretty obvious and they're right at the surface and you're able to latch onto them and plug those numbers in to your formulas. Okay, so we've talked about the expenses and they're not so hard to figure out most of the time, although I am going to address some expenses that can be a little tricky. But now we got to figure out the income side. Just because a property has an income or the rents are X doesn't mean that the rents are supposed to be X or that they would normally be X or that they're always going to be X. What we're looking for is a chance to move the rents up, or at least that the rents that are there now are comparable to the neighborhood. So you're going to have to know how to do a rent analysis. How do you zero in on the rents? Well, we can use realtors. We can use brokers, we can use appraisers, but sometimes those are a little more expensive. We can also use apartment locators, or we can just pick up the phone, and if there's enough rentals around us that we can identify with our eyes, then we can just start calling and getting a really good feel for what things rent for. The bottom line is this: if you don't get this right, then your whole formula is wrong. You have to get the rents right, and I'd rather be a little conservative than over-optimistic. If you have some friends that are really good landlords, maybe they're the best person to talk to about what you might be able to rent this prospective income property for. Now, I told you just a little earlier that some of these expenses can be a little tricky or a little misleading or work to undermine you a little bit. One of those such expenses is the property tax expense. Because while the property tax might be assessed at a certain level right now, after you buy the property, this property is going to be assessed at a new value and they may redo the property taxes in the very near future. So you want to be aware that the property taxes may go up. They would certainly go up if, let's say, there was an over 65 exemption for a lady and she's 85 years old now. So she froze this tax assessment 20 years ago. When you buy this property, it's not only going to incur an increase of 20 years on that tax assessment, but that property was valued at X way back 20 years ago, and you're buying this property at 5X now. And so there's going to be new evidence that the property has a new value. And if the taxing authorities go back and see the new sales price, coupled with they're going to take this over 65 exemption away from the property, you could be looking at an entirely different number, a substantially different number for property taxes at the end of the year. So just be aware of that. The property tax today may not be the same value as when you take ownership tomorrow. Another one of the categories of the expenses that are kind of tricky is deferred maintenance. That's very subjective. Of course, the seller will say that the property's in good shape, it really doesn't need anything. The buyer can look at it and go, well, it's obviously going to need a new roof in a couple of days and all this other stuff. So you want to look at the deferred maintenance. You might be buying a house where the water and everything's running right now, everything's fine. But within 2 years, you're going to have to replace a roof. And this roof is going to cost, $8,500. That's a profit killer right there. And while you're not having to look at it today or tomorrow or next month, certainly within the next year or two, you're going to have to replace a roof at a price of $8,500. That needs to be figured into your offer. Same thing with hot water heaters and air conditioners and sprinkler systems, gates, fences. All these things are going to have to be replaced at some point. You have to come up with a number for deferred maintenance, and it's very, very subjective. Let's make sure it's subjective in your favor. And then there's contingent liabilities. What's a contingent liability? Well, when you buy a rent property, you have to throw in some kind of contingent liability percentage because the property's not going to be rented every single day for the rest of your life. There will be move-ins and move-outs. How long will they be? How much will it cost to make ready that apartment when one tenant leaves and the next tenant comes in. These are very subjective too. And again, sellers will value this contingent liability at one value, probably not in your favor, and you'll have to give it a different value that is more realistic or represents what you're really going to incur. The problem with contingent liabilities is we're all guessing. You don't know how many move-outs you're going to have, and you don't know when the person moves out if they're moving out and leaving the house broom swept and pretty clean, or they're moving out and they've stolen all your appliances, your ceiling fans, and kicked holes in all the walls. You don't know. We don't have a crystal ball. So always be conservative in these estimates. Now I have a little bonus piece of information I want to give you, a little hint tip. Better not do this. But first I want to ask you to hit that like button and share with your friends. And if you haven't subscribed, please subscribe. I'm sure you'll find plenty of golden nuggets throughout the content that I'm going to be putting out over the next year, even longer than the next year. So please hit that subscribe button. We appreciate your support. And now I'm going to tell you a big mistake that people make when they're buying rental properties that already have tenants. Now the topic was how to calculate positive cash flow on the rental properties. But while I was talking to you about this, I thought about something that I see happen all the time. It's a very big mistake, and you don't want to make this mistake. So I'm going to throw this in as a bonus. When you're buying a rental property that already has a tenant in it, never close on that deal until you have documentation as to how that person is in that house. Because if you buy that property, you have to live by whatever the seller's documents say. And you may not like what it says. What if that person is in the house and it says in their documents that you have the right to occupy this house for $100 a month until you die? It's kind of a life estate clause. And then you buy the property, you're going to have to honor that contract. And that would not be good. The worst case scenarios are when you buy a house that has a tenant in it and there is no documentation. And then he tells you, well, the owner verbally gave me the house. I've been living here for 15 years. He said if I made my payments for 10 years that he'd give me the house. I made my payments for 10 years. I'm in the house. You don't have any documentation saying anything because you didn't get any. And now you've got a war on your hands, a legal war to possess a house that you spent a lot of money to buy. This is not how you should start out an investment. So I'm telling you from the bottom of my heart, please do not buy any rental property if you cannot get your hands on a piece of paper or some documents that describe how the occupant is in that house. It is a deal killer for me if they cannot produce documents. Now, there's one solution. If there's no documents today, before I close on that house, the owner and I have to draw up a set of documents that we have to get the occupant to sign. And if he will sign the documents stating what the relationship's going to be like, then I will go ahead and buy the property as long as there's some documents signed. But that's the only way I know to solve it. A lot of times owners are trying to sell the house to me because they have no documentation of why the guy's in there. And this guy's not getting out and they're in a war and he's thinking, well, the easiest way to get out of this war is to sell the house to Mitch. Now, if I'm dumb enough to buy that house without any documents describing how that occupant's in that house, then this man's won. He has transferred his problem to me, and that's not good for me. All right, I hope you enjoyed that little tidbit, that little bonus there. It didn't have anything to do with calculating cash flow, but it had a lot to do with not getting into trouble when you're thinking about buying a rent house that has an occupant. I'd like to give you a copy of my book, and this is a hard copy, 400 pages, My Life in 1,000 Houses, Failing Forward to Financial Freedom. I'd like to give it to you if you will please pay for the shipping and handling. It's about $7. And I'll get it to you. And I'm going to include a free video on my seller financing strategies and how and why they've worked for me for over 2 decades. So check it out. Simply go to 1000houses.com and scroll down the home page till you see a $7 book, and there it'll be.